Yeah, I think the two things that were really important last week was first, the fact that we got a jobs number that was significantly better than expected. The expectation was continuation of job losses, but we actually saw job gains. Now that's a great sign because that means that the economy's opened up and jobs are coming back faster than expected. And that really gave a really big boost to markets. The second thing that we were watching carefully was, would there be a rotation out of the winners that was leading the markets in the downturn and the early upturn into other areas that had lagged behind. And we saw that as well. Energy, financials, even the travel and tourism had a really good bounce back last week as those job numbers looked a lot better than expected. So obviously we continue to watch the job numbers, on a weekly basis now to see, is the trend continue to improve, or will those jobs that we saw last week only tied to the fact that as people opened up their businesses, they had to hire people back. But will they continue to hire people back, in the coming weeks and months, or is that the first set of jobs that are going to get hired as people start to look at capacity and say, I need that number of jobs for whether it's 10 people coming into a restaurant or 50 people coming to a restaurant. So really the continuation of that rate of change in employment will be very important to watch. And secondly is, will this rally between rotation of different sectors continue on, or will it just be short-lived? So you really want to see momentum, in these markets. I think the other thing I would like to add there is, do we see continuation of fiscal stimulus coming through as well? We've seen evidence of that in Europe, in the US. Will we start seeing it across the board? And will we see it in focusing areas that really need more and more help coming through? So that will continue to push markets higher. If not, there's potential for disappointment, somewhere down the road, once we start to see, markets expecting too much and maybe the governments or central banks not delivering as expected. Overall, we still have the long-term view that markets are eventually going to retreat back, maybe not as low as the March lows, but definitely, head down lower. And that really is tied to the fact that we think that jobs won't come back as fast as expected. And I'm not talking about in the short term, but really the long term, get back to the normal level of unemployment. So that's where we think our thesis relies. That's where we still have our underweight positioning. But we did bring back some of that underweight positioning, as the job numbers came out and we're a little bit more positive. So trying to mitigate the short-term risk of the upside here by adding to equities here. But we're also moving into areas that were being down a little bit more earlier on. So a bit more into international, a bit more into value. So areas that, again, that can still play a little catch up, as we see this market continue to move higher up on momentum. Yes, this protest has gone around the world. And, before we even get there, I want to put my thoughts and prayers out to the family of George Floyd. This really was some significant injustice that was being done there. In terms of the markets, I think it's important to understand that markets have been relatively calm. And I think it's because the protests, have generally in the last few days in particular been calmer, right? I think people have accepted what's going on and understood that there is an issue there. Companies and corporations are reacting with comments and hopefully following through with their, objectives there on making this a lot better. Generally, people have acknowledged this and taken this cause up together. And I think markets have appreciated that and have remained relatively calm. So therefore, it is a significant event, but not a significant event to the markets quite yet.